Hey everybody, it's Patrick Moore here with Ironclad Wealth Management. And the last couple times I've recorded one of these videos, I've talked about some pretty boring things, like some important things, but like not the most exciting stuff that'll really interest people. So I'm happy to say that today we've got something that's pretty exciting. It's not new, but it's been improved recently, and it's something that I think is going to be pretty popular moving forward in the next 10 years. And so what I'm going to talk about today is solar tax credits, specifically the improvements that have been made to those tax credits as a result of the Inflation Reduction Act of 2022. And I think it's going to be some pretty cool stuff. So let's just kind of dive right in. So looking at this, the first thing I want to say that I always say is, hey, none of this is individual advice. It's general information. Do with it what you will. Obviously, I hope that you learn something from it, but I definitely want to always remind you of that. Now, for solar tax credits, the reason I said they're not exactly new is that they originally came or basically created as part of the Energy Policy Act of 2005. But they were temporary, they got extended a few times, and what happened is in 2022, they were kind of slated to be really phased out as part of some of the most recent agreements. But the act in 2022 improved them. So it took the credit from 22% up to 30%, and then it extended it for another 10 years. So essentially, if you invest in solar property, and there's all these rules and qualifications and regulations, but the oversimplification is if you invest in solar qualified property, let's say you invest $1 million, you can receive a base credit of 30%, or in that example, $300,000, which sounds pretty nice. Now, that's an investment tax credit, and it's called an investment tax credit because it's based off of how much you invested. The second type of credit is called a production tax credit, which is based on how much energy you produce. We're not going to get into all of that, but that credit is also out of there. So today we're going to talk about those investment tax credits. So like I said, 30% base credit, but this is something entirely new. The IRA actually gives bonus credits for certain features. So when you're thinking about these tax planning ideas, you always have to ask yourself, why do they exist? Well, the government wants to incentivize clean energy. Then these bonus credits come in. They're like, okay, if you use US-based components, that's an additional 10%. If you site it in an energy community, that's an additional 10%. If you site it in a low-income community or on Indian land, that's another 10%. And then finally, if it's a low-income residential building project or economic benefit project, that's another 10%. So all of a sudden, we're talking about going from 22% in credits to 70% in credits. And very few projects are going to get all 70. Like, that's just not reality. But if you can make it happen, if you analyze those guidelines, then it can be possible. And I think really, if you think about it, though, there's a good chance that if you use a majority of US-based components, you could probably get that 40% credit pretty easily. And then, like I said, you got 10 years of that credit available. Now, how do you do this? There's two main ways you can access these solar credits. The first one is to actually form a business and do direct investment in solar generator or energy generating equipment that is solar based. That'll get you that investment tax credit. Like I said, $1 million in, $300,000 back right off the bat. The second is, this is new, you can actually use a credit transfer. So you couldn't used to buy and sell these, and there's some rules and regulations on these as well. Like right now, I think you have to be a C Corp to do it. But this is changing. The IRS has asked for comments on their guidance. There's a chance it might expand a little bit more. But in this example, you're not going to get a huge credit. It might be a situation where a solar company says, hey, we have no income for tax purposes, but we have all these credits we can't use. Let me go sell them to Patrick for 95 cents. Patrick gets his credit for $1 and saves 5 cents on his taxes. There's still a lot of guidance on that, so we're not going to get into all of that today. So there's three typical structures on direct investment, and this is what I want to spend some time on. It's sale leaseback, it's partnership flip, and it's inverted leases. That doesn't mean there's other ways to do this. That's just kind of where it's been, because these have been around for like 15 years. But this is how most people go about getting those credits, because a lot of times these developers doing the projects partner with somebody who provides the capital for the tax benefits, and then they run with the project and build it. So these have been around for a little while, and we're not going to get into the nitty gritty of all these, but I want you to be aware of how these work. The first is the sale leaseback. In this example, you as the investor bring the capital, pay the developer, you buy the solar generating equipment, Then you turn around and lease it back to them. They pay you for that each year, and it gets turned on. And essentially, there's an agreement with either a utility, a company, whatever it may be, to provide that power. Now, in this one, there's simpler reporting than some of the other ones we're talking about. You get those ongoing lease payments. And really, it's just a matter of, depending on how the project is set up, any of these three options may work for you. But that's how it works in a nutshell. Second, we've got partnership flips. In this example, you're not really separate from the developer. You actually form an LLC for the project, and you're both owners in that LLC. But the cool part about LLC and partnership accounting is you can have different percentages and allocations for taxes, profits, various different items as part of the operating agreement. So what happens in a partnership flip is you form a partnership. You as the investor get like 99% of the tax benefits, but you only get 5% of the economic benefits. Think those payments from that utility company, whatever it may be. It's probably not a utility company, just whoever is actually developing and installing that equipment on their property. The developer only keeps 1% of the tax because they're like, hey, we don't need that. But they then keep the 95% of the economic benefits. So essentially, you get what you want, which are tax benefits. The developer gets what they want, which is the project. Now, what happens though is this has typically a shorter time frame, and you'll see here I say typically there's a buyout, call it around year 6. That's because these credits, we haven't mentioned it yet, you have to invest and hold on to that business for at least 5 years, or those credits will be recaptured. Now, one thing about the partnership flip is they can be more complicated. You got partnership reporting, all those operating agreements, and they typically have larger tax benefits, but you're giving up a lot of those economic benefits that you can still capture in the sale leaseback scenario. And then the final option I don't want to spend too much time on, it's called an inverted lease. Whereas in the old one, you buy the equipment and lease it. In this one, you just lease the equipment and you're the one who contracts with customers and receives tax benefits. And the lease is structured in such a way that you do actually get those tax benefits even though you haven't purchased the equipment. So it's kind of a little different, but really what you can see is these are all businesses, right? You have to be involved. You have to be making those payments. You have to kind of monitor and maintain all of those businesses. And then that's how you get those tax credits as long as you're actually generating solar activity. Because there have been some tax cases recently where people said they were generating the electricity. The people who invested the money thought they were, but they didn't go with a reputable partner. They turned around and all of a sudden the equipment had never actually generated any electricity and they lost that benefit. So I got a little case study here. Say Joe and Mary. I've chosen these numbers just to make my life easy. They invest $1.25 million in an LLC taxed as a sole proprietorship, which means that really it's just earned income. So there's going to be self-employment taxes. They're married filing joint. They want to invest $500,000 in a solar project. Could be whatever. If you look on the right over here, what you'll see is you will see that Joe and Mary have about taxes due in 2024 of $466,000. Now, looking at that, if they invest $500,000 in this, the project they invest in is going to have a 40% tax credit. So let's just say it has U.S.-made manufacturing. That gives them $200,000 in tax credits year 1. Now, something that's interesting that we haven't talked about is that this equipment is still depreciable business equipment, so you can still benefit from depreciation and bonus depreciation. However, if you notice, this says $400,000 is the basis of this when you paid $500,000. That's because your basis gets reduced by half of the credit you receive. You still have it, it's just lowered a little bit. So in 2024, bonus depreciation is 60%. That's $240,000 of depreciation, which is $88,000 at 37%. Then there's, 2 to 5 years of depreciation left, and that's another $59,000 of taxes, which means in year 1, Joe and Mary save $288,800 in taxes with these numbers. Now, the total tax savings over time are $348,000 over those 5 years, which goes a long way towards getting that initial $500,000 back. However, remember in the sale leaseback, they get a payment back, and I just decided that it was going to be a 5% return. So that's 5%, that's $25,000 for 20 years. That is $500,000 of additional income to them, which means their total project benefits are about $848,000 over a 20-year time frame, with a lot of those being front-loaded with the tax savings. So you can see that they go from 488 in taxes down to 177 in taxes, or 466, sorry, down to 177 in taxes, which is $288,000 in change in tax savings. And then their net cash flow is minus $211,000, which really just means that their net amount at risk on this project is about $200,000 after year one, which is pretty favorable math. Now, what you'll see here, and I do need to stress once again that these are just projections, right? This is not a real project. Everything will be different. But what you see here, and something I want to emphasize, and sorry, let me go back for just a second, is look at what percentage of those project benefits is actually derived from that lease. It's about 60% of the project benefits are derived from the actual income payment on this project. Obviously, a lot of it has time value of money. It's not exactly like that. But there's a significant chunk of benefits that are derived from the project income, which what that tells me is when you're working on these projects, you can't just be chasing the tax benefits. It needs to be a real business with a real partner so you don't get screwed in that tax case I just mentioned a minute ago, and you can still rely on this income coming in moving into the future. Now, the second thing I want to talk about is material active versus passive debates and kind of how this works. So everything in the U.S. is either an active source of income or a passive source of income. If you've invested in real estate in the past, you probably understand how that works because it's probably considered passive. Now, to become active, and the reason why that would matter to you is in this example for Joe and Mary that I just discussed, all of that income is active income, which means a passive business credit cannot offset that income. So they would want their business, this new business, to still be active, which means that they have to be involved. I think a lot of times people expect they can just put their money somewhere and get these benefits, but in reality, you have to meet some of these tests here. And the big three tests are either you spend 500 hours in the activity, you do substantially all of the participation in that activity, and then which is not going to happen when you're relying on a developer and other people to kind of be involved. And then third, you participate for at least 100 hours and more than anyone else, or at least as much as anyone else. So what you see here is there's a pretty high bar to becoming active and being involved. And this is also an area the IRS is involved in. So as you look at this, if Joe and Mary's $1.25 million was all passive, then they could just invest in this and have it offset their passive income, like if they had a big real estate portfolio, like I mentioned earlier. They could just invest in this and not have to worry about spending the hours. But if you wanted to offset your W-2 income, if you wanted to offset your business income, there are some additional hurdles you'll need to clear with your accountant, with your legal team, whoever it may be, to make these work. Because like I said, it is going to be more involved than just investing and expecting it to come your way. So with that being said, that's the final thing I wanted to go over today. If you have to ask yourself, hey, what's the point of this? Well, quite simply, that tax credit changes the math on these investments, makes them much more attractive than they otherwise would be. And who is this for? Like I mentioned a minute ago, it's either for people with large amounts of passive income who can then offset it with a passive investment in business activity, or secondly, it's for people who do have a large amount of active income and can take the time and actually become involved in the project to be an active investor. So that's who these are for. Now, with all that being said, my offer to you, I always like to end these this way, is I work with business owners, 1 to 25 employees, with an emphasis on tax and financial planning. You can't do one without the other in my mind. And so typically that winds up with people who fall into that active definition. So there are people who always want to tell me, hey, can I just do this? And even though they're not going to spend the time, I want to offset my business income. And the reality is you just can't do that because it is something the IRS is aware of. So I'm typically working with people who can do that. We work on everything more than just taxes. But if you have any questions on that, if you want to go over that, if you think it might be a good fit for us to work together and combine that tax and financial planning, just let me know. Now, the other part is I'm always happy to take 20 minutes on an intro call to basically have any discussion of what's going on, even if it's not a great fit for us to work together. I do have partners who do this. I can just shoot you over to if it makes sense. So with that being said, hope you have a great rest of the day. The video was a little longer than normal, but I hope it was enjoyable.